In the prior slides, we focused on the cash acquisition for PPE, or the company acquired these fixed assets through cash payments. And the company can actually acquire assets, PPE assets, in different approach. So these are non-cash acquisition approaches. The company can purchase fixed assets through issuing a notes payable, or issuing equity securities, or may receive as a donation from the donor, or through the exchange of another non-monetary asset. So this is another probably property, plant, and equipment. Since it is not cash acquisition, the value of the assets is determined by either the fair value of the assets given or the fair value of assets received, which is more clearly evident. If the fair value of assets received is not available, we use the fair value of assets given. For instance, deferred payments. The company actually can acquire a property, plant, equipment through a deferred payments agreement. In this example, the fair value of the equipment was $41,323. This is given. So we know this is a value to be recorded in the book when the company acquired this equipment. Company does not make the cash payment immediately. Instead, it signs a note, and the payment will be due after 2 years. And the amount to be paid will be $50,000. This includes the value of the equipment plus the interest. So on the day the company acquired these assets by issuing a note, we debit the fair value of this equipment, or the price of this equipment, and credit notes payable. That was on January 2nd, 2024, which is the beginning of the 2024. And at the end of this year, the company should accrue the interest expense, because that's the 1 year period. The company should incur 1 year interest expense. The amount of interest expense is the face value of the note multiplied the interest rate. Since it is 1 year, we just multiply the annual interest rate. So interest expense to be accrued is $4,132. Well, this interest will be payable later by the end of 2025, so we credit a liability, interest payable. Then in 2025, the company should accrue another interest expense during 2025, and the interest determined by the sum of the notes payable and the interest payable in 2024. These two liabilities multiply the 10%. So that's interest expense incurred in 2025, or accrued interest expense in 2025. This is by the end of this year, the company should also make payments. We credit cash $50,000. The $50,000 actually is the sum of the interest in 2025, interest expense in 2024, and the fair value, the price of the assets when it was acquired. Actually, $41,323 is the present value of $50,000 at interest rate 10%. Our interest number of periods is 2 years. In this transaction, the company acquired an equipment through issuing a note. Why we use the $41,323? Because this is the price of this equipment, which is more evident. So we use the fair value of assets received. Here is another example. The company issue an interest-bearing note. The company acquired these assets with debt. Different from the deferred payment, we don't know the price of the equipment in this example. We only know the company who purchased the equipment agreed to pay $50,000 2 years later, from January 2nd to December 31st, 2025. So this is $50,000 in the future. And we are also given the implied interest rate 10%. And from the beginning of 2024 to the end of 2025, that's 2 years. We don't have the fair value or price of the equipment. So for this transaction, we actually use the present value of the note. We use the present value factor of the single sum and to get the present value of $50,000. This actually is the fair value of assets given. In other words, this is amount of sacrifice the company has at the present value. So we debit 41,323 and credit notes payable. This is debt, and the difference we debit discount on notes payable. And then the calculation is based on the 2 years present value factor at 10%. In the next 2 years, by the end of each year, we're going to amortize the discount on notes payable. So by the end of 2024, we will debit interest expense based on the product of 41,323 and 10%. 41,323 is a carrying amount of the debt, which is a difference between notes payable and discount on notes payable. 41,323. The interest expense 4,132, interest payable 4,132. And after this transaction, we credit discount on notes payable. The notes payable balance originally was debit 8,677 will be reduced. So here this T account shows us originally discount on notes payable was 8,677. After this transaction or amortization, we credit discount on notes payable 4,132. The balance reduced. Or the carrying amount of debt will increase. The amount increased is 4,132. We add to the original carrying amount at the beginning of 2024 to determine the interest expense in year 2. So 4,545. And also this is the second amortization on discount on notes payable. After this amortization, we credit discount on notes payable. The balance of this account becomes 0, fully amortized. Okay, the carrying amount of notes become $50,000. By the end of 2025, the company paid $50,000 and credit $50,000, so the debt is paid off. Interest expense is determined by the carrying amount of notes payable. Originally, at the beginning of the year, it was 41,323. It actually is the difference between 50,000 notes payable subtract 8,677. Next year, the carrying amount will increase. The reason is amortization on these accounts. Okay, so that's the year 1. Year 2, it will be 50,000 subtract 8,670 subtract the amortization. Because the balance of discount on notes payable decrease, so the total carrying amount will increase. This should be 55,455. So these two carrying amount determines interest expense and the discount on notes payable. Sometimes we are not given the interest rate on the debt. We are only given the price of the assets. So we're going to debit equipment using 79,383, and this is payable. The difference will be recognized as discount on notes payable. That's for the zero interest bearing note. Again, this amount will be amortized similarly to this example in the next 2 years. When the discount on notes payable are fully amortized, the balance of this account will be 0. Then the company will debit notes payable 100,000 and credit cash 100,000. So these are all examples when company use debt, different type of debt, to acquire a fixed assets. And we choose the value which is more evident as a book value of the assets acquired or received. So here we are given two values to determine what's the book value of assets to be recorded on the acquisition day. We are given one is a cash price, 120,000. Another one is notes payable, which is the future cash amount, after 3 years, from beginning of 2024 to the end of 2026. So which one we use? Actually, we use the price, which is more evident. So since we are not given interest rate, so this is non-interest bearing note. In other words, 200,000 is a future value of 120,000. There's an implied interest rate here, but we use the value which is more evident as the book value of the assets.